the second question, Bruno, I think we're going to get into the second question. So this one, I think obviously you are the right person to deal with this one. It's centered around trust, and I think it's a question we've received before, but we're always happy to answer questions as they come up because things do change. So the question is quite straightforward. Are trusts still considered a good idea from a tax perspective, and why?
Sure. So a lot of these questions, so trusts and the use of trusts have become predominated, especially from a tax perspective over the last couple of decades. But over time, it's become less and less popular. Now, one needs to understand that it does depend on your current personal circumstances, whether trust is worthy of your attention or not. So the first thing I'm going to start off with is just briefly touching, especially since we're only dealing with a tax perspective. In a broader sense, when I normally approach trusts, I speak about tax efficiency, but I also speak about asset protection and financing optimization. So these are all structuring techniques. But if one focuses purely on tax and how trusts interact with tax, the first thing that I do want to mention is you shouldn't get a trust purely on the tax basis. It shouldn't be the only consideration because it's not designed for that. So it is, yes, it might be one of the upsides and something worth considering, but it shouldn't be your sole consideration. So moving on to the next thing. When one looks at tax, right, we need to look at the different types of tax so that we understand them before we can actually comment on the efficiency of a vehicle that you're going to pick. So taxes, for example, you're looking at your general income tax. So that's tax being levied on revenue that comes in. You also have capital gains tax. So capital gains tax is when you sell something, a capital asset. So like a house, for example, that you lived in or you used to rent out to people over long periods of time. Now you sell that, but you bought it for a certain amount, you sold it for a higher amount. So the difference between that is considered capital gains. So in the property space, since this is the property law lines, in the property space, when you deal with income that comes in. So when you receive your rent, that's considered revenue. You're going to pay your normal income tax on that revenue that comes in. Your capital gain is when you sell that house that is giving you the rent, and now you're paying tax on the difference between the what you bought it for and what you sold it for, right? So now bear this in mind. There's the one odd situation where you look at a property investor that flips properties. So in that instance, the flipping of a property is actually considered to be a trade. So the income that you receive, the difference between what you bought it for and what you sold it for, is actually revenue. Not capital, because you didn't hold it as a capital asset. You didn't enjoy the fruits as much as you just sold it as trading stock, the same way that you would buy whatever, a bottle of Coke and sell it on to somebody else, right? So just bear that in mind. So you've got revenue type, and then you've got capital gain type, right? Now, this is when you're running a business. And as a property investor, this is typically what you'd have when it comes to revenues and all the rest. Now, outside of this, you've also got something that's called estate duty. Now, estate duty is only levied against individuals. So not companies, not trusts, only against individuals. And it's almost like a wealth tax. So if you pass away and you have a lot of money, SARS wants to get a bit of that money out. So SARS will levy 20% at certain times, 25% of the value of your estate. So very, very quick example, on an estate of 10 million Rand, you typically find anything between 30 and 40% of that estate goes towards costs, part of which includes 20% towards SARS as a tax, right? All right, so now we've got the basic understandings. There's many other types of tax types, but these are the ones that specifically you can associate to trusts. So now in a trust, right, the trust itself has a very high tax rate. It really does have a very high tax rate. But a trust does not have any estate duty, because when you pass away, it doesn't impact the trust. The trust owns the property, not you. So you pass away and you get charged estate duty. But if the property is in the trust, no estate duty. So a trust may have a high tax rate, but no estate duty. So now it starts becoming a numbers game. So you start looking at this and going, well, so how much would I actually pay in a trust if there was a capital gain versus how much would I actually, and remember, with a capital gain, you only pay on the gain versus estate duty where you pay on the value of the entire estate. So it starts becoming a numbers game. So what is your estate worth? If your estate is very little, then the 20% might not be a lot versus the costs of administering a trust versus an estate that's very high value. There you start asking, whether trust is whether trust might be necessary. So just already now bear this in mind. So you've got your estate duty versus your normal taxes. Normal taxes are payable on a daily basis. Your estate duty only payable if you own the property and you pass away. So that's a very kind of simple connection. Then on top of that, trusts have a conduit pipeline principle. So all that means is that if a trust receives money, but it gives it to its beneficiaries immediately in that year of assessment, right? The trust doesn't actually pay the tax on it. So if the trust receives rental but gives it through to the beneficiaries, guess what? The beneficiaries are going to pay the tax in their personal name. So now the upside to this is the trust holds the asset. So if you pass away, no estate duty is payable, but you're still getting the benefit of the rental income going through the trust into your pocket, and you're paying on your personal tax rate, which might be lower than a trust tax rate. So now you're already starting to see a couple of benefits here, right?
Yeah.
Throw a company into the equation, and you've got more maths that you need to look at. What I find from practice is this question is very common amongst property investors simply because the value of the assets are very high. So it's very simple. Somebody, for example, that has, a couple of things here and there, a couple of 100,000 maybe in shares or equity or whatever the case is. Do I need a trust? Honestly, probably not. Maybe you do. Like your circumstances would dictate, there's a very good chance that a trust might be overkill. As soon as you start dealing with properties and the assets are over 1 million, 2 million, anything over 3.5, definitely, because over 3.5 is when the estate duty starts kicking in. So, and as soon as property investor building up a portfolio, you also want to make sure it's in the right place. So even if it's only one property, but you're planning to get 10, also consider the fact that trying to move it later is going to be virtually impossible. So plan ahead, try to figure out what you're trying to achieve. It's not to say that it's wrong to have things in your personal name, but and it's not wrong to say that maybe a trust is essential, but it's important to consider that depending on what your plan of action is, that you actually do the right calculations and basically figure out if it is tax efficient.
Yes.
In addition to offering some form of asset protection, in addition to being able to optimize your ability to get funding from third parties.
Wow. Okay. So you've actually explained it so well that I have no questions, which is why I was here. So yeah. Thank you for that. But what I did pick up is that it's important that you speak to somebody that knows the details of exactly or what you might need. It's important to sit down and to consult and to see what best suits you and your plan, and what vehicle you should use towards that wealth preservation and what route you should take. Yeah, number one. And number two, it's obviously there is no one standard answer. It's different. Yeah, it depends. There's no one size fits all. So yeah, always speak to somebody who knows the legalities, of course.
Sure.
Yeah.
Cool.
So yeah, I think we're done. Nicholas, Bruno, anything to close off, or you're good?
No, very happy.
100%.
I'm good. Cool.
Yeah. Thanks, guys.
Perfect.
Awesome. Have a great
Thanks,
one, guys. Cheers.
Cheers.